Hi, in this video we're going to cover the market to book ratio, and this is very simple, but the whole objective is to avoid the students getting confused with what is the market value, what is the book value, and how do we know the difference, when to use market value, when to use book value. So let's just calculate the market to book ratio of any firm, and let's just discuss why we have book value, which is different from market value, right? So the first thing is, let's assume that there is a company. Let's call this market to book, right? So the issue with the book value and the market value, and let's assume that a firm is buying property, right? The firm will have an account which is property, land, and equipment. It will have a building. Usually when they buy this building is finally accounted for in the books at book value. Now, this building will gain appreciation. Probably the businesses surrounding this firm will start to flourish, or this area will start to become more expensive, and hence this building in this particular location may gain an appreciation that is not reflected in the book value. So that is why then book value at some point of the firm starts diverging from market value. And some firms that have been in the market for a very long time will have a very substantial difference between the book value and market value. This is also the case of companies that produce intangible products, such as think about intellectual property kind of products. And at some point, these products become so popular that there is a huge market value, but the shares or the value of this firm in the books is much lower than the actual value that investors are willing to pay for it. So if you try to buy a stock of one of these firms, you will have to pay a large amount of money. But if you actually look at the book value, then the book value will be much lower. So that's why we end up having usually two kinds of firms that have a high market to book value ratio and a low market to book ratio. So first let's calculate quickly the ratio, and then I will quickly explain what literature and research say about market to book in most of the cases. So we have, let's assume this firm has current assets of 10 million. So we have current assets, and it is important that we are just having the current assets separated from the fixed assets, and it is just 10 million, and then these assets can be sold for the book value. They can be sold, these assets can be sold for 10 million. Now the company has fixed assets in an amount of 60 million. However, the fixed assets have gained appreciation, so if they want to sell it, they could sell for 90 million. Okay? So now, let's assume that this firm has a debt with a book value of 40 million. And the debt also has a market value of 50 million. Okay, so let's assume the interest rates went down, so the value of this debt actually went up. Okay, there is this relationship between interest rates and the value of liabilities. So if interest rates go down, usually liabilities will increase in value, and the other way around. So we have what is the debt, and we have what are the assets, and now we want to calculate, or we can calculate easily, the market value of the firm and the book value of the firm. So what is the market value of the firm? So when we are calculating the market value of the firm, we just simply state everything in market value and we forget about the book value. So everything is relevant in market value. So we have current assets which are the same in this case, book value and market value. And we have fixed assets that actually can sell for 90 million. So we have 100 million market value. Then we have debt, and we can calculate the debt as 50 million, which is the market value, right? And then this is market value of the assets. Let me just put it here, assets. Then we have debt, market value. When we get the difference, and the debt market value is just 50 million, right? So when we get the difference, then we have that the market value of this firm is just 50 million. Then if we use, instead of the market value, we want to get the book value, we just use the book value of all these accounts. So the book value of the assets is simply these 10 million in current assets and the 60 million in fixed assets. So the book value, let me use here this different color. So the book value of the assets is the 10 million of the current assets, which this is the book value, and then 60 million of the fixed assets. So we have 70 million. And then the book value of debt is actually $40 million. So when we get the difference, we will get that there is 30 million. So we calculate the value of the firm on a market value basis, then on a book value basis, and finally we get market to book ratio, which is simply calculated as this 50 million, or the market value of the firm, divided by the book value of the firm, which is this 30 million. And there we go, we have 1.67, which is a market to book ratio. Now, firms that are characterized by steady growth, so let's just assume that we have two firms and we will have a high market to book, and then we will have a low market to book. What does a high market to book value implies? A high market to book ratio implies that the difference between the market value of the firm and the book value of the firm is wide, is substantial. And this happens when investors account for opportunities of growth ahead in the future. So usually these firms are likely to be the ones that are constantly appreciating in price. So these firms are usually providing investors with accelerated growth of the company and hence accelerated or higher returns, right? So we would have a firm that is increasing, or the price is just providing higher returns, and this is happening in a much faster pace, right? So it will be, but these firms also have higher volatility, because let's think of one company that is innovating in the automobile sector, and then we are all expecting these automobiles to outperform the market and come up with brilliant ideas. So because the investors expect so much in the future, they are willing to put their money in that stock. It's not related to book value, it's related to the value that the firm will attain in the future. So this firm will continue to grow just like this, right? So these are growth investors. Growth investors invest in high market to book firms. But at some point, if something that was planned does not materialize, then it may fall sharply. And then it may continue going up. We cannot predict what is happening with this firm, but we have high expectations of growth. Low market to book implies that there is a lower difference between market value and book value. think about this grocery store, or think about these companies that have been there forever, maybe selling some basic need products. So these firms do not have this sharp, volatile, increasing pattern. They will have a more steady pattern, maybe like this, right? Think of one big beverage company or food company, and they will have a slower growth, but it will be more constant, and there is lower volatility, at least in average, right? Now, which of the two investments is the best? Should we invest in firms that are growing at an accelerated pace, or high market-to-book ratio firms, or low market-to-book ratio firms because they are growing at a more steady pace? That is something that has been debated in literature, and so it depends on your objectives. It depends on if you're investing in the long term or if you're investing in the short term. And so it depends on whether the investor is betting on the short-term growth or long-term growth. Then the investor may opt for one of these high market-to-book securities or firms, or low market-to-book firms. So I hope this is making it clear, or that you are able now to understand what market-to-book ratio is, and moreover, what it implies for investors. Thank you very much for your attention.